Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute for December 15th, 2013. Markets had a bit of a rough time last week, selling off, ironically enough, on the prospects of a budget deal looking good. If you're wondering about the logic of that, I'm not sure that logic is the right word we should use. But the reason is that traders feared the chances of December action by the Federal Reserve Bank going up as a result. When the Fed pulled off its surprise no action back in September, one of the reasons the bank cited was uncertainty over the impending budget and debt battle. Ergo, no budget pain might mean no bank morphine. The historical pattern for stocks this week is to rally up into the Fed meeting and then sell off afterwards. So I would expect some movement up the first couple of days, aided by the usual dip buying. After that, the usual thing for the markets to do is to sell off, sometimes that afternoon and sometimes the next day. Since the meeting comes with Chairman Ben Bernanke's last press conference, I would guess that prices sitting still will not be the result. There's a usual amount of intense guessing about what the Fed will do this week. I would guess that the current odds are about 1/3 to 1/2 expecting that the Fed will do some sort of tapering action at this meeting. Now, those odds might be a little skewed by people not wanting to be caught off guard, even if they don't really believe the Fed is going to do anything. For myself, I don't know what the Fed will do. I think the bank should have started tapering back in September, and since it feels to me like the bank will probably want to wait until January or March, that may very well mean that they will start this week, given how often Bernanke has surprised me in the past. The other question this week is whether or not traders go for the defiance trade. Markets usually sell off after a Fed meeting, but in December things are less predictable, with calendar performance numbers in play and, more importantly, the semi-mystic faith that retail investors have in the December rally and the Santa Claus rally that is supposed to get underway in the back half of next week. Now, if the Fed does put in some taper, the history of Fed tightening moves is that an initial sell-off is usually followed by a strong upside reversal. Some of that will just be traders following market law and tradition in search for quick profits, and some of it is testosterone. But a lot of it will depend on how much short interest there is in the market. The New York Stock Exchange short interest report for the end of November showed a modest creep up to a 2-month high, but that often changes quite a bit in the 2 weeks leading up to a Fed meeting. If there has been a big buildup, the chances for a short squeeze rally go up quite a bit. Be careful of such rallies because the press never has much of a clue about them and just rants and raves a lot of hot air about the great bull market. It will still mean a less accommodative stance by the Fed, and the markets will get the message over time. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.